Hello and welcome to That Investing Podcast. We are in Season 2. This is Episode 2 of Season 2. And I'm pleased to announce we are joined by Felicia Hjertman, who's the founder and CEO of UK-based retail investment platform Tillit. Felicia, hi, welcome.
Hi, thank you for having me. Delighted to be here.
And I'm also joined by my co-host at large, Charlie Arch. How are you?
I'm feeling wonderful, Simon. How are you today?
Feeling wonderful. You don't sound it, but anyway, I'm glad you are.
That's not a very nice way to start the podcast.
I'm like that. I'm grumpy Yorkshireman. Felicia, I got your surname right in the pronunciation, didn't I?
You did. You did. Very impressive. You did. Well done.
Yes. No pre-warm-up exercises required for that one. That was great. Okay, Felicia, thank you for joining us. So, as I intimated there, Tillit, a UK-based retail investment platform. Tell us about the journey and the creation of Tillit, please, would you?
Well, that's a big question. I think I can start with, I guess, where it started. So I used to work in asset management as a fund manager. So I spent 8 years with an asset manager called Baillie Gifford, which some of you will be familiar with. And absolutely loved my time there. It's a very interesting job. Managed Japanese small cap equities for the last 5 years. And that was very, very interesting indeed. Could talk about Japan and small caps all day long.
We could.
But essentially the reason why I left Baillie Gifford to set up Tillit comes from really a challenge that I had personally in terms of managing my own personal savings, which sounds weird because I was kind of an insider in the industry. But really at the core, and I'm sure we'll dig into it more, but at the core, I found as a personal investor, thankfully having access to a lot of different things nowadays, but the issue is with what do you do with that access? How do you make a decision that you know that you're investing in the right thing that is right for you? You're confident in understanding where your money is actually being invested, and generally just make decisions that are best for you for the long term. And I didn't think that was as easy as it should be. And also seeing how the experiences with the institutional investor, pension funds, sovereign wealth funds, so on, the access and the information they have access to in order to make their own decisions is very different to us as individuals. So trying to bring that to the individual, empower the individual to have the chance to be in control of their long-term savings and make the most of them. That's really what we try to do with Tillit.
Interesting. So why Tillit then? What's the name? I mean, I've obviously read up on your website and I know what it means, but tell our listeners, all two of them, what Tillit means.
So Tillit means trust in Swedish. And for us, it was really important to find a name for the company. Naming a company is incredibly hard to do, by the way.
Yeah.
There's trademarks, there's all kinds of things. And we wanted a name that was easy to pronounce, ideally one word, but particularly had meaning to what we do. And I think when it comes to financial services, when it comes to people's money, trust is the holy grail. If you can't gain someone's trust and if you lose someone's trust, then you're dead. And everything we do is about earning that trust of the customer. And the reason we came up with the Swedish one is because back to it's really hard to name a company. We put through all of the different words. We wrote a long list with all kinds of different words that we think would be great to name the company in English. Couldn't get a single one of them for loads of various reasons. Mm-hmm. And then translated the whole list into Swedish. And it was my co-founder's wife. We still have a picture of her picking it out on a Post-it, Tillit, which, and I don't think I've thought about it in that way before because it's pronounced slightly differently in Swedish. But to her, obviously, it just looked like a cool word and is a palindrome. So anyone working on branding loves the fact that it's palindrome and you can do something.
Oh, it is, isn't it? I like it even more. Oh, that's brilliant. Can you tell us how to pronounce it in Swedish then?
Tillit. So it's just a little bit different. So Tillit sounds a lot quicker and easier. And Tillit it's just a little bit different.
Oh, I like it even more now. Palindrome. I love Sonos and things like that. That's just brilliant. Oh, brilliant. Excellent. Well, thank you for that introduction. And I can see Charlie's eyebrows raised significantly there when you mentioned Japanese small cap stocks, because that's one of Charlie's favourite subjects, isn't it? Small caps.
Small caps in general. Japan, I'm slowly getting into, but it's very tricky. Just finding the information in the first place is a bit of a nightmare. But going back to Tillit, the investment sector is really competitive. There's dozens of platforms, and obviously you are breaking through. But what unique gap in the market are you addressing? How does your approach differ from the other investment platforms available?
So I think for us, there's, if you look at the whole market, you typically have kind of two sides to it. You have the big supermarket DIY platforms with thousands and thousands of options, which have the majority of the market share. And then what you've seen over the last 10 years or so, you've seen the whole build up of the robo space, where it takes the decision off your hands and someone else kind of makes those decisions, and you kind of been put into some default funds, usually with actually only passive, and you don't have to make many decisions. And there isn't really anything in between. And whilst I think access is the great kind of first step in terms of democratizing investing, access is just one part of that. Then you need understanding to know how do you make the right decisions for you. And that's really, I think, the more complicated part. There's a lot of noise out there and there's a lot of options. And I think even people who are already comfortable with investing takes a lot of time to dig through not just the volume of information and choice, but also then figuring out what do each of these different investment solutions offer me. And so therefore, what we're trying to do with Tillit is to reduce the choice paralysis problem by offering only a curated platform. So every single thing, we only focus on funds, and we can come on to that as well. So we don't do individual stocks and shares. We're about long-term investing. So it's funds, investment trusts, and ETFs, passive and active. And the reason for why we curated is because we want to make sure that there's only so many asset classes, so many regions, so many styles. You don't need 350 in every single category. There's only so many ways you can do something. And so we take our expertise and we scour the market for what we think are the best in class options within each of those areas, so that you as an investor, regardless of what you're looking for, can find what we think are the best choices. And then we give you the information about those funds in clear, plain English, succinct summaries, so that you can actually take control of your money and feel confident about what you're investing in.
It kind of sounds like, I don't know how to describe it. Okay, right, I'll give you an anecdote. I was in South Africa a few years ago, right? A few years? Okay, more than a decade ago now. And I went into a restaurant, and I thought it was a restaurant. It is a restaurant, but all they had was beef stew, right? All the wines in the world, but beef stew was the only thing on the menu. So we had beef stew, and it was delicious. Now, I remember saying to Susie, my wife now, but girlfriend back then, that, there was only one thing on the menu. Had there been loads of stuff on the menu, this restaurant would be much, much slower. And I'm guessing for you guys, and maybe the analogy is better as a sweet shop, I would say, rather than, you've got 1,000 different chocolate bars. We've curated a few different bars in a box, and you can pick the right one for you. Is that a fair analogy, would you say?
Yeah, I think it is. I mean, we use different ones, whether it's restaurant, whether it's a wine list, whether it's a curated kind of high-end fashion retail shop. It's trying to give people breadth, but without overwhelming people with choice at the same time. And I think you don't, just because there is curation doesn't necessarily mean limitation. As long as actually, if you compare our universe, as we call it, with the best buy list, which is probably the closest thing to on a DIY platform, if you look at the breadth within our universe in terms of even the range of asset managers, we have some really small boutiques that no one's ever heard of, but they do an amazing job for clients because we've found them because they do an amazing job in that particular category. So you can have a lot of breadth, but that doesn't mean volume just for the sake of volume.
So, I mean, before I switch back to Simon, the part of that component for a lot of investors is going to be sustainability and ethical investing. Obviously, ESG is kind of in the spotlight at the moment. A lot of investors are kind of turning away from it. What kind of initiatives or policies do you have in place to cater to to that kind of ethical investor? And what do you do to kind of like ensure there's no kind of like greenwashing or social washing? If you know what I mean, that's kind of a concern, I think, in the industry.
Yeah, huge. I mean, this is an evolving area, and we are a DIY platform, so we don't give personal financial advice. And so what we try to do when we build this universe of curated funds is we don't make a judgment call or telling you should be investing in X, Y, or Z. But we want to make sure that there is great options for any investor. And that includes someone who wants to invest sustainably. And so we do have a decent portion of the funds on the platform, both passive and active, which are sustainable funds. But what we do within that, and we analyze them just as much as we do any other funds. And in fact, there's even more questions related to them in our own kind of bespoke proprietary due diligence questionnaires, the way that we talk to fund managers, all of the ongoing research. But I think the key thing really is that sustainability is really complex and there's a lot of subjectivity with that. Yeah. And so what we try to do is bring in even the way that we filter those funds down. We have a unique filter. If I can just take an example, we have a unique filter that you don't really see elsewhere, which is called kind of prohibited from investing in fossil fuels. Yeah. And how that filter has come about is that we have gone into the mandates, essentially like the rule book for all of the funds on the platform. And we looked at the funds that have an explicit rule that it doesn't allow the fund manager, or whether it's a passive fund, to invest in fossil fuel stocks ever. Now, that is very different from, there are some sustainable funds which don't have that.
Yeah.
And it depends on the philosophy. So I think it's just being clear with the investor. Yeah. To give them the chance of, you can trust that what you think you're investing in, you're actually investing in. And so I think it's, again, trying to play back from a user's perspective. What is it you're trying to do with your money? And how do we do all of the groundwork and all of the extra effort to tell you that in a way that you can trust that? So that's just one example that we do that. But we just recently added a sustainability expert to our investment committee. And again, we're not a sustainable investing platform, but we take it very seriously.
Wonderful. That is a comprehensive answer. I mean, this is one of the questions that I kind of deal with on a daily basis. One of the things that I'm kind of into at the moment in the small cap space is mining, right? So lithium mining, critical minerals, copper. It's very easy to say, okay, well, that might be an ESG investment, but actually to get those minerals out of the ground in the first place is really carbon intensive. So balancing those things is really interesting. And some people will look at a mine and go, actually, that's not ethical. And others will look at it and go, actually, that's, the best thing we can do for the planet. And, is balancing those things is tricky. It's tricky stuff.
That's the thing, right? It's not even about tricky. It's like, who makes the judgment call of what is good or bad?
It's so subjective. Yeah.
And I think that's also why it's so important that, we talk about access and information. For us, we have for every fund, we have what's called a Tillit view, where we describe what it does. And if it's a sustainable fund, we have things of what does it exclude? How does it view? Is it a transition phase into, if we're talking about renewable energy or whatever it is?
Yeah.
Because you can't make a decision. I think a lot of people think they're invested in some sustainable vehicles, and then they realize if they ever do, what that is invested in, that's not aligned with what my beliefs
with your own principles. So you're giving them the information that they need to align with their own principles, rather than kind of just saying, stamping it essentially and saying off you go, which seems like a great way, in my opinion, to do things.
Yep.
Simon, next question, please.
Yes, I'll have a question, if you don't mind, Charlie. Now you've finished with your life travels to South Africa and your beef stew.
Wow, it's always good to get a quote in. But no, that was a good holiday.
I'm more interested in what wine you chose for that, actually.
I don't remember, but I don't really speak any of the languages in South Africa other than English, and but we had red. That's all I remember of the night.
Really?
It started with red. It continued with red. And then, a couple of days later, we woke up. And that was my last time in South Africa for a few years.
Great. Well, I'm going to try and think of an analogy now, but I can't, because I'm going to ask the question, Felicia, what technology underpins the platform, and how do you ensure the security of your users and their privacy of investments and data? A bit of a boring question, but we've got to throw it in.
No, I mean, it's really important, right? Because again, trust comes back to, the thing is with money and with investing platforms, there's so much that you need to put in as like hygiene factor, even to get you started, and to make sure that you are protecting people's money and you are setting everything up securely, because once you lose that trust, then, you're screwed. And so I think, for us, just because we're a small and a new company doesn't mean that you have to cut corners. We take it very seriously. Everything is hosted in the cloud and AWS, but all of our data is encrypted, both as you supply it to us, as we store it, transit, all of those things. We offer 2-factor authentication to our customers to secure their accounts. We have secure document upload. If we need any extra information, we undergo regular penetration testing, due diligence of our technology partners, and regular compliance training, and all of those different things. It's just coming together. My co-founder, who's the CTO of the business, he's a stickler for this. So it's definitely something that even in the very beginning, in the beta period, and people are like, oh, you don't have to set it up this way. And it's like, no, we're doing this properly from the beginning. And I think that's key, right? Because at the end of the day, it's people's money. And so we need to do what we need to do, whether we're small or large, to secure that as well as we can.
Excellent. Yeah, absolutely. Couldn't agree more. I mean, that sounds like one of the challenges that you actually had on the journey was to probably not cut corners, because it's people's money and it's very sensitive. Have there been any lessons on the way, do you think, that you've learned from, because you've not set an investment platform up before, I take it?
No. Went for founder, so and Paul as well, and neither of us have built an investment platform from the start. I think, we say this all the time, that had we known how hard it was going to be up to this point, even, you wonder, would you have done it? And I think that's part of the beauty. It's like climbing Everest, but only seeing up to the clouds and not seeing how far you have still to go, right? So I think there's a lot of of course, there's a lot of challenges. We were born essentially in COVID. Paul and I, who's my co-founder, we worked together for a full year without meeting in person. We've only ever raised money virtually. We've never spoken to investors in person to get money into the business. And we built a culture with also completely virtual. So we have offices in Edinburgh and London now, but we're completely hybrid models up to people. Some people come in 4 days a week. Some people come in once every 2 months. I think building a culture where the team is split between different locations, also another challenge. And I think maybe the last one I'll mention, I mean, there's so much that's really hard, right? But I think the last one is also, as we talked about earlier, with security and so on, it's finding the right partners, because fundamentally we can't do everything ourselves to get out there, and there will be more and more things we take in-house as we grow. So it's really important that we have the right partners who also have the right culture and so on internally, but are also willing to challenge the status quo, to break things, for lack of a better expression, to really change and to build things differently. And if you don't find those partners, then we can't grow. If our custodian doesn't do a good job, then we can't do a good job to our customers. Data providers, we can't deliver great data. And I think, taking one simple example, our fee structure is unique in the industry. That creates a lot of problems for our partners, because our fee drops by 1 basis point every year that you are a customer, regardless of how much money you have, because we believe that is the right thing to do. Everyone should benefit from lower fees over time, because investing is a long-term thing. But that is a completely new way to take fees. And so that provides challenges. So you need partners who really believe in what you're trying to change in the industry and how you try to help people. That's hard, I think.
Well, that's interesting, because it's almost like you've read these questions, because the next question I think Charlie's going to ask is about the fees and the business model and how you make money. Were you not, Charlie?
I was indeed. How does it generate revenue? What's the value proposition compared to traditional investment methods? And I guess a third question, tie-in, is if the fee drops, with every year that you're using Tillit, presumably the compound returns will be much higher than with competitors. Is that a fair statement, or I don't know?
Yeah, so I'll come back to that one, and we always have to be a bit careful, right?
Not financial advice, no promotions there, mate.
Our clients will listen back to this be careful. But no, I think, so the fee model, our business model, is super simple and straightforward. And that is because so for me as an ex-fund manager, I've analyzed these kind of businesses a lot. And I know that there's a lot of potential to build a great, strong, sustainable business if you do it right. Yeah. That's very important, because we're here not just to bring in lots of customers for free who we then can't actually serve over the long haul because we're not built a sustainable business. But it's also particularly important, I think, to be clear to the customer. How are you charged? So we only make money in one way. And that is through the platform fee that we charge. So that starts at 0.4%, which is under the kind of market leader in the industry, without naming names. But the key thing that's different with that is indeed that it drops by 1 basis point, so 0.01%, every year that you're a customer, regardless of how much money you have, how many accounts you have. So if you open an ISA today, and then you open let's say a SIP, a pension with us in 5 years' time, then you'd pay 0.35% on the assets in those accounts together. And the key, and that is until it goes to 0.25%. And we don't charge for dealing. So even if you're trading something that's, if you're buying or selling something that's trading on an exchange, like an investment trust or ETF, we absorb those trading costs.
Wow.
So that it doesn't become a more complicated decision for you as an investor. We want you to be really clear on what you're charged. And then, of course, there's the fund fees as well. But we play all of that back to the customer in pounds and pennies based on how much you're investing as well. So, and we pass on all of the interest that we earn on uninvested cash straight through to customers, which is now 3.35%, which we're not even a savings account. We think you should be investing, but equally, we don't think that's our interest to take. That's yours. So we pass that all through to you as well.
I mean, it is interesting the way different platforms fund each other. I mean, arguably, I guess a follow-up question that's not on the list is that if different customers are buying different ETFs or different funds, presumably, depending on the funds they buy, depends how much revenue you make for that customer. So I guess my question is, does that not create an element of, is bias the right word, where you want to push customers towards the funds that generate the most revenue for you, would you say? Or
the beauty of that is that we're not allowed to push anyone into anything. So
no, that's fair. Sorry, maybe that's not a fair cop. I guess I don't know. I guess I'm just thinking from a marketing perspective, and I forget sometimes that compliance exists.
No, I think it's because we don't give advice. I think if we could actually promote funds in a different way, I think maybe that would be a more trickier challenge of how do we get balance there. For us, we look at all of the funds that are on Tillit are there because they are what we think are best in class. And that includes the best value for money in terms of trading, in terms of the fee you pay for the fund. Now, if you choose to trade more investment trusts, like we pay for those trades, but we're also a long-term focused investment platform. So we don't make money off getting you trading more. We do indeed lose more on that. But because we focus on funds and because we are trying to be very clear with customers around the kind of the purpose for this is investing long-term, our customers are also those people who are using Tillit to invest long-term. Mm. So we do find that if anything, we don't really have traders on Tillit. Like if you were looking to trade, you probably wouldn't choose Tillit. No. If you're looking to invest long-term and do that at great value and do that with confidence, and you really want to be in control and know where your money is without having to spend all your waking hours finding that out, then Tillit might be a better fit for you. So I think whilst there is a risk there for us, it's very much goes along with what we're trying to do, and that is aligned with what our customers are trying to do. So we think it's worth taking that cost, just like there's any other cost of doing business, and we don't look at it beyond kind of that in terms of trying to promote one over the other.
And you keep it simple, which is, the name of the game.
I think simple and transparent is key. Yeah.
I reckon Simon's got the next question. What do you reckon, Simon?
Oh, I reckon as soon as I've prepared for this podcast, Charlie.
That's a good idea.
I might even throw a little sideball question in, because I'm obviously looking at the website, looking at Tillit and your proposition and how transparent you are on the fees. I was just reading those as you and Charlie were discussing them. Nobody else is doing this, are they?
No.
In your space? Nobody's reducing the fees and giving back that interest.
I think so. There are other platforms who do give back interest. Some give all of it back. Some take a cut. But I think on the interest side, we definitely, and that's been key for us even when interest rates were at zero. When we had that conversation with our custodian, we wanted to make sure they don't take a cut, we don't take a cut. And at that point, it was kind of a non-issue. But for us, it's always been core to, we want to be very clear with customers. And again, it comes back to that trust point. And I think just to kind of go back to what you were saying earlier, Charlie, around kind of compounding, whilst we can't, promise future returns, the thing that is clear with fees is that if that is going down every year, and usually markets over long periods of time go up. And so your wealth should grow over time. And that is even without you making contributions. But let's take you're 30 and you're investing for, at the moment, we don't have a pension product live at the moment, which I'm sure we'll come on to later on in discussion about that.
I was going to ask that question, yes.
But I think even in an ISA, let's say you're using it to invest long term, you start today at 40. And in 15 years, you'll be paying, you'll be 45 years old and you'll be paying 25 basis points, which usually is a fee that is allowed for the very wealthy. And I think, therefore, looking at your pot should be much bigger, and you lock that in from then on. And it's not just on your pension, it's on all of your accounts. And so the more you keep to yourself in terms of not having to pay in fees, obviously, the more you can earn a return on that, and that compounds over time. So it is very much, we set the model both to be clear and simple and easy to understand, but also so that our future success is aligned with yours. There should be mutual loyalty there, and that if you win, we win kind of thing. If we pick great funds that gives you a good return after fees, then your assets should grow. And even if we take a smaller fee, overall, that should be a mutually beneficial relationship.
Interesting. So the pension product isn't available yet. Can you give any sort of indication when that may be available?
Well, I should probably say 2024, because that is to be on
the right answer.
But it is a key focus for it. It's always been, ever since we before even starting Tillit, pension is what makes it's completely aligned with what we're trying to do, of empowering more people to really take control and understand and reduce that anxiety that people have around the financial future. So we're doing some very interesting works on pensions at the moment. And we have customers sign up to our waiting list to get told as soon as we launch that SIP as well.
Sorry to interrupt, if you don't mind me asking, it seems to be, it's not just Tillit, it seems most investment platforms, when they're starting out, struggle to add a SIP straight away as in private pension products. Is there a reason for that? Is it more complex to get online than like an ISA or a general investing account? Or do you know why that is?
I think, if I was going to guess, I can't speak for other platforms, but I think maybe there's a couple of things. I think one is ISAs and GAs are a bit more easily understood and common in the market. And so in that sense, it's a less of not as many people are not just aware of a SIP, but also feel that they feel confident to kind of use a SIP. And essentially a SIP is just another pension product. It just means that you pick your own investments.
Yeah.
And so you're not put into a default fund. And that's the main difference. And then you make those decisions. But I think so a lot of people don't feel perhaps confident there, which makes sense because there's, you have to start somewhere and be a little bit more familiar with investing. I think the other thing is from a provider point of view, you have to find a SIP partner. The cost with offering a SIP is higher than it is with other wrappers, I would say, in general. And so therefore the volumes of assets you need to pull in to make that a kind of a viable proposition is harder. So again, I think it depends on your strategy, but generally I would imagine it's a combination of those.
Was that self-fulfilling prophecy then? If it's harder to do, fewer platforms will provide it, and then it becomes harder. I guess you've got the fintech space is evolving really rapidly. How are you guys staying ahead of industry changes? What kind of innovations are you bringing to the market?
So yeah, it is evolving rapidly. And I think a lot of that is focused on kind of the technology innovations. I'm sure, AI plays a big part in it. There's a lot of different views there. I think for us, it's because we're coming at it from that point of view of how do we help people make better decisions? A lot of what we've done so far has been very focused on the quality of the funds, the quality of the content. We interview all of the managers. So from a technical angle, I'll come on to the portfolio builder in a second, but most of the initial value has been around how do we translate the expertise that we have in a way that we put it in the hands of the person who needs to use it. So it's much more qualitative. I think the next part of that, though, is using both the expertise and what we can do and the access to the data we have because we go deeper on those funds, because we're curated. So the portfolio builder, for example, is a tool that allows you to make changes. First of all, build a portfolio before you even have an investment account with us. So you can put lots of funds in your basket, see what does that mean for asset allocation, regional allocation. And when you're ready to, if you want to then open an account or log in, you can check all of that out as one order, rather than having to place lots of different orders and so on. But you can then rebalance your portfolio using that tool as well. So if you want to make changes to your asset allocation in one way or another, then that tool allows you to do that in a way that I used to use a spreadsheet for this stuff. I mean, it's ridiculous. And a lot of people would still there. Yeah. And I think so at the moment, it's kind of V1 of that's live. But the stuff that we can do to make that so much more powerful is really, really exciting. So it's building on that, but it starts at the core with information and qualitative data that is much more rare and I would say more defensible in that sense than some of the other stuff. So that's where we started, but it's how we bring the two of them together that becomes really interesting.
Yeah, I mean, I guess a lot of that will be inspired by the pandemic. Obviously, it's changed the way a lot of businesses operate. How's Tillit adapt to these challenges? What changes have you seen in consumer behavior regarding investments on the platform?
Yeah, I mean, so as I mentioned earlier, we were founded in the pandemic, so we don't know anything else. So from a company perspective, we and I think that's a blessing, right? We didn't have to change from everyone coming into the office to how do we do this now? It was more just we can't see anyone, so how do we build a company? Actually, Paul and I had a conversation at the very beginning as well. So Paul lives in Edinburgh. I used to live in Edinburgh when I was at Baillie Gifford, and I now live in London. And one of the first conversations we had, he was like, I'm not moving to London. I'm like, I'm not moving back to Edinburgh. I was like, great, then let's build a company that works, virtually, because we set that from day one. I think from a consumer perspective, so we launched the platform into beta in April 2021. And so again, I mean, even since 2020 to where we are now, it's been very interesting, volatile times in the market. And to be honest, what I expected to see is a lot more momentum-driven, panicky kind of behavior of what people do with investments. And I've been very pleasantly surprised to have to see that, if anything, we see our customers not kind of pouring out in panic when things are going down. And if anything, adding both more money to the platform, but also to their investments. And they're not making lots of trading changes. They're actually seem to be exhibiting a very long-term focused investment behavior. And equally just looking at logging behavior and all of that stuff. because of what we do, we're quite different to what a trading platform would look as good metrics, where you want to pull people in because you want them to trade because that's how you make money. We want people to make good decisions and kind of leave them be, because there's one thing that I know as a fund manager, a great way to destroy value is over trading.
Yeah.
So we don't want to incentivize that. We want to make sure that people feel good about the decisions they make and they know why they made it. So it's early days, but what we're seeing is indeed that behavior, which is quite different to what you're seeing in the general market.
Yeah, sorry. I mean, before I hand back over to Simon, I wonder how much of that is because obviously you launched during the pandemic in kind of April-ish, up until around November 2021. Pretty much anything you invested in the large cap market was going up. Thereafter, it started to go downhill, for a bit before it recovered. But I guess, maybe you had the advantage of you launched and then for 6 months straight, that regardless of what you were investing in, pretty much everything was going up. So those early investors who got in, saw things were going up, invested more, and then when they started going down, they had that trust that you knew what you're doing. Would you say that's fair?
I mean, that could possibly be fair for that first cohort, but most of our current customers have come in since we opened up to the public at the end of 2021, when you've seen a lot more volatility. And in terms of what, the end of technology being the silver bullet and all of that stuff, and it's become much more complex to figure out where to put your money. And so it's even customers who've been with us from day one as a beta customer who are still with us and adding on new ISA money and new other money as well. But it's also the people who come in since then and has come in very choppy times and still kind of seem to be kind of making those decisions with a long-term focus in mind and not panicking as much. And I think, I would like to think to an extent when we talk to our customers, a lot of what they say about Tillit is that they feel that it's either validating what they think they knew or it's really trying to understand. We have people who've been investing for several decades who say, I've been investing for over 20 years and I come onto Tillit and I finally understand what this fund does. It's like, that is crazy that it's taken so long. So I think therefore, because they feel more confident that they know what they're investing in, you therefore don't panic as much. We even have a section in the Tillit view saying how might it perform in different market conditions. So if we've said this is something that's particularly sensitive to rising rates, interest rates, and then interest rates rise and it moves along, you're kind of like, okay, well, that makes sense. That's what this should be.
Do you know, I think this is one of the key things I've tried to explain. A lot of the people I've worked with over the past sort of decade or so is that not everybody understands everything about finance like you do. So you've got to put it in the terminology that the average person is going to understand.
Yep.
And if that's something that you do, and like looking in your platform, your website, you seem to be doing it very successfully, which, is the name of the game.
I mean, I would say that's the hardest part. Like, even, I'm just going to give one example, is that we've given all of the funds a nickname, almost like a one-liner, where we try to describe in a nutshell, like, what does this fund do? Rather than, emerging market, ex-China. Like, it is to people like, oh my God, you lost me 3 words in.
Yeah, indeed.
And so we try to, again, make that clear so that people find what they're looking for, what's right for them quickly and easily.
Yeah. Simon, do you want to take the reins for 5 minutes? I feel like I've taken all the time from you. I'm sorry.
Yes, I will, Charlie. I'm enjoying the conversation. I'm listening as I scroll through the Tillit website and look at the Tillit dark universe.
Indeed, I was looking at the dark universe.
I thought you might have been. So I'm looking today going, what's this? I like this. What is it?
Well, I think. I'll summarize it as, Felicia can correct me if she wants, but when you want to transfer your investments over from one platform to another, ordinarily what you have to do is you sell the shares that you have or the funds that you have and then buy them in a new platform. And the risk you have there is that, especially with something volatile, you're buying at a much higher or much lower price. I think what the dark universe allows you to do, if I'm correct, is allows you to transfer your investments over to Tillit without having to sell them in the process. Is that the key idea, Felicia, or is it...
She's smiling. Yes.
That is indeed correct. And I think, in specie transfers, it's like the industry jargon term, right, of having been able to transfer without selling is more common on the big platforms, but not necessarily with all of the platforms. And I think for us, the reason we're doing it is twofold. One is because what you just said of, you're investing for the long term and you don't want to sell out of a particular time. And sometimes you can be out of the market for months because a transfer can take forever depending on the provider.
Yeah, exactly. Sometimes a day or two, especially with funds, it's a bit different with like small cap shares, your speciality. Sometimes you're in a company for like a year waiting for that one announcement. It comes on the day you've had to sell because you transfer platform and you're out.
Yeah.
And so it's a big advantage, I guess. It is. Yeah.
And I think the second thing is obviously we are a curated platform. So if you own things that we don't have, you might be like, well, I have this fund. I really love this fund. And so that's the other thing. We want to make sure so that you're allowed to transfer that in and you can continue to trade it. You can continue to buy it, you continue to sell it, but it lives in our dark universe, which means that, Charlie, if you transfer in a fund that we don't have, let's pick a very famous one that we very noticeably don't have, which is Fundsmith. Everybody loves Fundsmith. You want to transfer Fundsmith in, you can do that, and you will see it on your dashboard. You will see the quantitative data about holdings, performance fees, all of that stuff. But if you, Simon, come in and you look at the Tillit universe, you won't see Fundsmith.
Right.
And that is because that's why it lives in the dark universe. So it's there to support Charlie and his decision to invest in that fund, but it's not a fund that we have, for whatever reason, decided to offer to our broad universe. So that's why we've done this, so that it's easy for you to move. And again, it comes back to it should be easy for consumers to pick the right platform for them. And so enabling people to transfer in what they've already decided to invest in before, as long as it's funds, ETFs and investment trusts, then we will support you in doing that.
Yeah. And you can't shift individual stocks and shares into Tillit, though, can you? You'll have to sell those.
No, that's where we draw the line, because we're focused on funds. Yeah.
Or cryptocurrency or leveraged ETFs. I'm reading on screen.
That is again. Yeah. Yeah.
Well, let's not go into cryptocurrency. We'll be here forever.
No, Charlie. We've got a bingo card.
Stay out of that
We've got
one.
a bingo card of. Well, interestingly, no fractional shares either, I'm thinking.
We do currently offer fractional shares.
Oh, do you have fractional shares in ISAs there, Felicia?
Well, we do at the moment, and that is obviously very light. So for us, it isn't a huge part of the business, because the only things that it would apply to is the exchange traded instruments. So that's the investment trusts and the ETFs. And the most expensive by share price investment trust we have sits around 50 something pounds. So of course it's not nothing, but we're not talking about shares that are costing thousands and thousands of dollars. But so we do currently offer it. It is very much a live debate, and we are in conversations with our custodian around what's going to happen there. And I'm sure are you probably interested in hearing my view on that?
I have a view, so I'd love to hear your view.
Charlie's been very vocal on social media about this, because I think
do you know?
Come on,
I'll let you say your view first, Felicia. I think that's probably best.
Yes, there you go. Let's ask the question, because Charlie did lambast our financial editor a little bit on fractional shares and ISAs and HM.
Right.
I know. Well, it was a debate, wasn't it? It was a debate.
Indeed.
What is your stance, Felicia, on HMRC's stance on fractional shares? Do you think they're going to... What do you think they're going to do?
I can't speak to how it's going to end or how it's going to be resolved. What I can share is our views on fractional shares. Fundamentally, fractional shares, I personally believe, and we as Tillit believe, democratizes access to the markets and to being able to build wealth. And I think the whole point is that stock markets and investing in general used to be something that was, reserved for the privileged few. And fractional shares is one of the things that allows more people with less money to be able to benefit from the wealth creation in some companies or whatever it is. And I think the thing with it is, so we think it's a great piece of innovation. And there are companies out there which, back as a time as fund manager, we always wondered, why don't you just do a share split? And then, you reduce the price of those shares. It doesn't reduce the value of the company. But for whatever reason, some companies don't want to do that. And so you end up with having that barrier. And whilst there are drawbacks with fractional shares and the rights you have on the fractional component of that, what fractional shares allows you to do is at least benefit with what I think is one of the core fundamental parts of investing, which is wealth creation. And so whilst you may have challenges around voting and other things, by being able to hold the fractional part of something, you can at least benefit from that wealth creation. And so we think this is an opportunity for all of the platforms, ourselves very much included, to highlight in plain English more what are those drawbacks, what are the cons that you should be aware of when you are owning something in a fractional part. But I don't think the solution is to ban them out of ISAs and scare everyday investors and to think that is a lot more risky. I think it's understanding what you're investing in, but giving people the option to do so. And then you can talk about regular investing, which again is a very good habit to get into, to invest regularly. And regular investing, unless you have thousands to invest every month, again, you wouldn't be able to buy some of those very highly valued stocks without fractional shares.
Yeah.
So we are for it. We think it's a great piece of innovation. And this is, of course, not personal financial advice, but it's like, there's a thing of, it's not personal financial advice. It is just general view on what fractional shares enable. But we have to be clear as an industry of what the drawbacks are as well.
Yeah, I guess, my perspective, my first perspective is, HMRC saying fractional shares aren't allowed in ISAs. Legally, the current legislation says only shares are allowed in ISAs. So I have a legal background. My perspective on it is that HMRC's hands are tied at the moment, and what they're doing is just waiting for the government to give direction. Now, my personal concerns with fractional shares, and I do agree with all of your points. But the first is voting, and I guess maybe this is because I focus a lot on the small cap market rather than the larger cap, and I guess fractional share ownership isn't that much of an issue down there because often the share prices are smaller. But I think when you have fractional shares, you disconnect investors from their kind of the idea that they own that part of the company, if that makes sense. If you have one whole share of like Apple or Coca-Cola or Tesco or whatever it is, you have a voting right attached to that, and I think if you only have like a partial shares of each company, it reduces that connection between you and the company as an investor, as a part business owner. And, potentially that's, maybe not that relevant to the average person buying shares and regularly investing. But to me, I like the idea that companies are beholden to their shareholders, and the more fractional shares you have out there, the less they have to answer to those shareholders because they simply don't have the voting rights.
I'm going to challenge you on that, Charlie, actually. I'm going to challenge you on that. So let's say you and I are both shareholders in Tesco, right? So we're both allowed to vote because we're shareholders of Tesco. But you've got one share and I've got 1.1 shares. So I've got a fractional share of Tesco, slightly more than you. Am I not allowed to vote?
Oh, no, you can vote with your one share.
1.1 share.
But you can't vote with your fraction of a share. But the issue is obviously with a company like Tesco is probably not a good example. Say Apple.
No, I know.
Apple or Microsoft or whatever, where like one share might be $100, $200 or whatever. You might have only sort of 0.9 of a share and you've got no voting right, even though you've invested, for you, maybe a substantial amount. Now, I don't think, obviously, for the average person, that's not going to matter, but I worry about market stability over the longer term if more and more fractional shares add up and add up and add up. But then I think the other thing is, and again, maybe this is beyond my pay grade, but when you have a company like Apple, for example, and they set their share price at that, value, and they decided they don't want to do a stock split, and obviously these companies do stock splits every few years as the share price goes up and up and up. There's a reason why they set it at that price. And obviously there's arguments for or against why. But I think maybe it is a good idea that you should just have to have those whole shares. But again, I'm not married to the idea of not having fractional shares, but I do think that in a marketplace, I don't know. I guess it's an ideological standpoint rather than a practical one. Maybe that's how I feel.
Thank you, Charlie.
Sorry, I'm lingering on. I'm not trying to.
Just go back. Can I just go?
Yeah, please do. Yeah, go for it.
I do agree with everything you said, and I agree. I think HMRC are legally within their rights, but that's, for me, this is an opportunity to change legislation and look at this legislation appropriate for what we're trying to do and what we're trying to do for consumers, and is it aligned with that? Now, you are absolutely right on the legal point. My point is, and I agree with the whole, okay, well, you don't have you have a 0.9. It's all about how do you get to getting more people to have a voice? And I think if it's really hard would you rather exclude people until they have accumulated that wealth that they can buy one share and then they have a voice? Or is it potentially so that they can get to owning that whole share and more by being able to fractionally and slowly build that up through regular investing, through hopefully market movements, and you get there quicker for them to then have a voice on that one share. Until you do, only the people who are wealthy enough to buy whole shares will have a voice. And is that really right?
My basic thing on it is the autumn statement in the UK. I think it's the 22nd or the 26th of November. So, within 3 or 4 weeks from now, Jeremy Hunt will want it. There's going to be new ISA announcements regardless, which are going to be quite exciting. They say they're going to simplify it. I imagine they'll just make it more complicated. That's what politicians like to do. And I imagine that a quick and easy win will be to say, we've amended the legislation, you're allowed fractional shares in ISAs, and that'll be the end of the conversation. But I worry, and I have no specific worries because I can't really articulate them, because again, it's just, I feel that it's one of those things where we don't know where the rabbit hole will go. But having said that, your point about, being able to, and I guess I am a higher earner, so maybe I am, maybe slightly more biased towards this. But if you're, investing over time and then you can build up to that whole ownership of shares, that is definitely a good thing. So maybe I'm in the wrong. I don't know. I just have concerns about it.
I mean, I don't think it's an easy topic. The last thing I'm going to add, which was also potentially slightly controversial, but
please hit me.
If you really look at what does this mean? Let's say, for instance, we ban fractional shares out of ISAs.
Yeah.
And potentially just generally it's coming across all of the accounts later, but even whether you do it or not, ISAs is kind of the way in for a lot of people
almost,
into invest.
90% of people, tax efficiency.
Yeah. And exactly. And so if you do that, what does that mean for competitive dynamics in the market? Because if you look at it in terms of which platforms are offering fractional shares at the moment, without naming names, there is a pretty clear divide between the ones that do and the ones that don't. And if you're looking at competitive dynamics, and I even have it on one whiteboard actually, but the FCA's core objective is to promote competition.
Yeah.
And I think therefore looking at what the platforms that are doing this, a lot of what, and I read mostly, as I said earlier, for us, fractional shares isn't a big part of the business. So we don't have a dog in this fight. But
neither do I, really. Sorry, we've taken up too much time on it, but yeah.
Yeah, but there's an element I think is really important for the investment platform market as a whole of what happens here, because a lot of new businesses have built a whole business on the fact that they are able to do this. If they can't do that anymore, what does that mean for overall competition? And at the end of the day, the competition, who suffers? The consumer.
Indeed. But, right, and I had this exact conversation with a colleague the other day, but these platforms who have built their platform will be able to offer fractional shares within an ISA. Have they now had a competitive advantage doing something technically illegal over the other providers, generally older, we won't name names, who haven't done that potentially because they've done their compliance due diligence?
Charlie.
I don't know. I feel like we could talk about this forever and ever.
Look, this is the democratization of investing. This is you're basically saying don't allow poor people to invest because they can only buy fractional shares.
No. Delete that bit, son. No, I don't know.
Chance, we're leaving that bit in.
My basic perspective on it is all a kind of a moot point because I don't have the power to change anything anyway. And 3 weeks from now, the Chancellor will make a decision to score cheap political points, regardless, for what he's going to do. I mean, I think that's the bigger question. What's he going to do about the ISAs in a few weeks' time? They say they're going to simplify it, but I think they're going to make it a lot more complex. They tend to do.
Well, we heard it first on this podcast, Charlie, from you, Charlie Archer. He says they're going to simplify it, but they'll make it more complicated.
100% certain of that. Of nothing else. I only know politicians. I think we have 6 ISA products at the moment, and they'll scrap one and add 3 more. That's what they'll do. No idea.
It's like a game show, isn't it?
Yeah.
Brilliant. Felicia, thank you very much for your time. That was very, very interesting conversation about your background, Tillit, and your views on fractional shares, as well as Charles's, and of course my slightly left of field interjections there. Thank you very much. That was That Investing Podcast. Guys, thank you very much for joining us.
Thank you so much for having me. It's been great.
Bye, Simon. That's been great.
Bye-bye.
Bye.
Thank you for listening to That Investing Podcast, brought to you by the team at Investing Reviews. Check out our latest stock market news and analysis at investingreviews.co.uk. You can also find us on Twitter and LinkedIn. Just search for Investing Reviews.